Hello, we're going to present our answers from accounting study case. We got Chelsea, Adeline, and me. So for number one, we have property value, which is we consider it as opportunity cost, and we also have grading and refurbishment, expansion effort, consulting fee, and from that we sum it all to get the total fees of 7,055,100. Next to number two, we got smart home project and flagship project. First, we go with IRR smart home project. And for year one to year five, we have this static amount, the same amount, which is 35 million. And starting from year six to year 10, they increase 5 million annually. So from that, we got 78.685% with the initial investment of 45 million. And for payback period, which is initial investment divided by annual cash flow, here means 35 million divided by 25 million. And from that, we got 1.28 and something. And then from that, we know it will be 1 year. And from 0.29, we times it with 12 months to get the month. And we got 3.48 months, which we round out to 1 year and 3 months. For the MPV with discount rate of 10%, so the incremental revenue savings becomes the incremental net income. And from that, we also minus with the capex, and we also put the capex of 63 million in year zero, and then from there we got NPV of 74,529,737. For the flagship store project internal rate of return, we know that year one to year three they have the same amount, which is 18 million, and starting from year four to year 10 they increase 3 million annually, and from there we got IRR of 64.644%. MPV with 15% of discount rate, we got 30,869,298 with the same calculation with the smart home project, just with different amount. And for the payback period, we also have the same formula. It's 18 million divided by 6 million to get 1.667. And then from 0.67, we times it with 12 months to get the month. And from that, we know it's 1 year and 8 months. So from this choice, we chose to choose smart home because it has higher NPV, higher IRR, and higher payback. And because Apple is going to expand, so it's more suitable for NPV and IRR. Since for expand, it means like it's already a big company, and they both usually like kind of similar in level of people use it. And IRR is more about the percentage, and NPV is more about the amount of money that they will get. Hello, we're going to present our answers from accounting study case. We got Chelsea, Adeline, and me. So for number one, we have property value, which is we consider it as opportunity cost, and we also have grading and refurbishment, expansion effort, consulting fee, and from that we sum it all to get the total fees of 7,055,100. Next to number two, we got smart home project and flagship project. First, we go with IRR smart home project, and for year one to year five, we have this static amount, the same amount, which is 35 million, and starting from year six to year 10, they increase 5 million annually. So from that, we got 78.685% with the initial investment of 45 million. And for payback period, which is initial investment divided by annual cash flow, here means 35 million divided by 25 million. And from that, we got 1.28 and something. And then from that, we know it will be 1 year. And from 0.29, we times it with.
Hi, my name is Adeline, and I'm going to be answering question number 3. So we are choosing Smart Home Project because we believe that Smart Home Project is more diverse compared to flagship store project, because it was mentioned that they are doing an expansion in Chennai, and they didn't mention anything after that. So I was assuming that they are going to open the store in Chennai only. It was like saying only Chennai people need the store, while Smart Home Project is more diverse, like spread all over India rather than just the city. And it could also create new revenue streams and a more cost-saving choice. So for companies, they could use Smart Home Project, the data that they collect, by knowing how we use electricity, consumption, usage, and behavior. And from the data, they could innovate a new technology to cope with the problem they're facing. So hence, a new revenue stream. And for consumers, smart home is a more cost-saving choice. Like for example, it could help you save finding by automatically sense that you're not in a room anymore, and how it will contribute to sustainable growth. So it was mentioned that they are hoping that the project could help highlight ISG capacity to manage a dynamic portfolio and utilize state-of-art manufacturing techniques. So this dynamic portfolio that they're saying is how they are choosing India, which is a good country, basically because of their large population. And even though it was known that India is a poor country, but I found out that their middle class population is growing, so it's a good thing. And there's a survey done in 2023 with 4,043 consumers did the survey, and it was known that 52% of them they have smart home, and 43% doesn't have it, and 6% never heard or don't know about smart home. So 52% is a high enough number to say that this is a great country to expand this smart home. And state of art manufacturing techniques. So state of art is like manufacturing techniques is latest up to date, so it aligns with smart home rather than just a store. And driving innovation in a competitive market. So I mentioned that they have smart home. That they have smart home like 52% of them, and it is mainly Amazon. Like Amazon has the highest market share of smart home, and it follows with Google 11%, Xiaomi for 8%, and last one is Apple 2%. So this is a competitive market that they're saying.
Hi, I'm Chelsea, and I'm going to talk about number 4. Before we decide our strategic financial decision, we first have to count the free cash flow. So the period of time is divided into 5 years, and for the revenue, we got the number by multiplying the unit selling price, which is $800 per unit, with the predicted units sold. So the first year, we started off with 1.6 billion, and with an incremental increase of 8%. This is why the revenue is increasing each year. For the variable costs, we use the operating expense amount, which is 1.2 billion, same as the revenue. It will also have an incremental increase at 8%, so the variable cost is also increasing each year. And after that, we also have a straight line depreciation that is divided into 5 years, so each year has $2 million. And after that, we can count our earning before tax, and with 21% tax, we can finally find the incremental net income this much. Moving to this section, we know our net income each year, and based on the research and based on the study case, we also know the required human capital this much. And this $10 million is the initial investment that they have to invest in the specialized equipment. So this is when the year 0, they will have an outflow of money. And for the working capital, starting from the year 0 until the 4th year, this amount of money will be subtracted from will subtract our net income. So the net income is less, but on the 5th year, this amount of money will be added back to our net income because the money is recovered. So after that, we can know the free cash flow. Although on the 0 year, the number is negative because they have to do a huge investment. But as we can observe from the 1st year until the 5th year, the number is constantly increasing and it's positive. The number is also extremely high. So this is why we are suggesting Apple to do an expansion, to expand as their strategic financial decision. So they already have a plan about this AI project. Instead of canceling it, instead of just doing it, we are suggesting Apple to expand the project because the cash flow, the free cash flow are highly positive.
So to break even, we need our net income to become 0, and net income is contribution margin minus fixed cost. But because of break even, contribution margin equals fixed cost. So we need to find the quantity. It was not given, so we are going to change it into a variable Q. And then we need sales price. We are using the budget price, so it's budgeted revenue divided by 200,000. We got this. This is per unit, so we times Q, and we got sales. And the cost per unit, this was given. It is also times Q, and we got variable cost. And we need to find contribution margin, that is sales minus variable cost. So this minus this equals this. This is our contribution margin. And I mentioned before that fixed cost equals contribution margin. Fixed cost was given, and we know contribution margin, so we divided with 4.14, and we got Q, the units sold. So it was 176,086.96 units. So this is a reverse analysis. And then to find the actual cost per unit, the 180,000 unit, the total cost of it is what it was given. And to find the per unit, just divided with 180,000. And then we got the total variable cost. This is from this adding this and this and this. It will have the same amount if you divide this with 180,000. And for fixed cost, we didn't divide it because it's fixed cost. So we use the total fixed cost divided with 180,000, and we got this. And the total cost is total variable cost at total fixed cost. We got this total cost per unit. That is our total cost per unit. It will also have the same amount if we divide the total cost with 180,000. And net income is from revenue minus total cost.
Flexible budget variance. So to count the budget per 180,000 units, we first have to find the budget per unit. How to count the budget per unit? We use this data. We know what is the budget for 200,000 units. All we have to do is divide the amount of money with the unit, and by that we can know the budget per unit. After we know the number, we find the variance and we determine whether it's favorable or unfavorable. In conclusion, the revenue is favorable because we earn more money than what we have budgeted, but unfortunately for the variable cost and the total fixed cost is unfavorable because we spent more money than what we have budgeted. So yeah, and this is why it will also lead to an unfavorable variance of net income because we got less money than what we have budgeted. Moving to the 6B, labor rate and efficiency variances. We first decide the actual labor rate per unit, this much, and this is the standard labor rate. And by that, we find the difference, which is the variance, this, and it's unfavorable because we spent more money to pay labor rather than what we have budgeted. So for the labor rate variances, we count it using this formula from the standard labor rate and minus the actual labor rate, and this, we multiply it with the actual units produced. So the labor rate variances is $733,800, and it's unfavorable. For the efficiency variance, we are referring to this formula, and after doing the calculations, the variance is this much, and it's unfavorable because the actual units produced is less than what we have budgeted. So we are receiving less money than what we have thought. So this is why it's unfavorable for us. For the 6C, overhead spending variances. Overhead spending variances is the fixed cost, and we agreed because it's fixed cost. No matter what the quantity is, the amount of money will remain the same. So we decide the variance is this $7,000, and it's unfavorable because we are spending more money than what we have budgeted. And now I'm going to discuss number 7A. Our main reason is that we cannot find enough skilled labor, and that is also why we failed to reach the targeted production quota. Our suggestion is to employ automation in the production, like buy more machine, invest in machine. So by that, we don't also have to rely on the labor. Hopefully, by relying more on machine, we can also produce more and achieve the targeted production quota. And for the Samsung flash memories issue, we are suggesting instead of just like sourcing from Samsung, which is too risky, they can explore other alternative suppliers, like find more suppliers, like other suppliers for such a critical components, so that when unfortunate events happen, the risk is not just gathered at one spot, it's divided. So the potential risks can be mitigated, it's spread and become even. So that's all. Thank you.
For the number 7B, if they reduce the assembly and packaging from $13.11 to $10.11, they will have $1,819 in early month operation results, which are already less than the planned cost, which is $2,622. They can also reduce monitoring costs from 127 to 120. So overall fixed expenses will be 722, which is lower than planned fixed cost of 729. And with all of this modification, their total cost will be $36,861, and their net worth will be 37,476 subtract with 36,861, which is $615.
Okay, so for production output, the first thing that they could do is address the main problem, which is the Samsung overheating. That could be why they could only produce 100,000 units rather than the budgeted 200,000 units. So the variance there could be due to like the failed products due to overheating. So for in the long term, I was suggesting that they could change suppliers and maybe not Samsung anymore. Or if they still want to collaborate with Samsung, maybe they should add more suppliers. So it could cover the failed products and achieve the production of budgeted units. And for labor costs, because of the cost for assembly and packaging cost is for actual is higher than budgeted. I suggest they could do minimalistic packaging or sustainable packaging. So they could get rid of less useful materials for packaging, like here Apple and Samsung doing the sustainability trend. It was proof that doing the sustainable packaging can reduce costs and better image. And focus on the product more. So let's say because of their minimalist packaging, they receive like negative result complaints. So to cover this, they could maybe focus on their main product, increase its quality, and implement strategies to reduce defects and rework, right? Like the Samsung case. So that's all from our group. Thank you.